Now that you have an idea how much money you're going to need to get your business started, and you have a feeling for what potential income will come from the business and feel comfortable that you'll be able to repay debt service, you have to think through where the money is going to come from to get the business started. One of the things to keep in mind is that in spite of what you'll hear on TV or see on the internet, there really are no grants for business startup. When you think about that, that makes sense that there would not be money available to just give to small businesses, unfortunately, because many small businesses don't make it through the startup process. Now, that doesn't mean yours won't, but it is something to consider and to understand why there's that hesitancy to just give money to people who are starting a small business. There are some programs out there that, for example, the Small Business Administration offers a guaranteed loan program. That loan guarantee isn't to you, it's to the bank, that says if you would default on the loan, they will help make that payment. So that's an option that sometimes helps make it easier to get money through a bank, but there are no outright grants of dollars. Now, I say that, and there's always exceptions. In the last couple of years, there was one program that the state put together that was an out-and-out grant, and it was a competitive grant, so there was no guarantee that someone who applied would receive funding in the period of time it took to go through that process was extensive. So it was a grant that people had a short closing time to process that. But then the actual turnaround time to find out whether they received the money was almost a year. So just understand that when you're looking at grants, it's not a simple process and certainly not a guaranteed process if you can find anything out there that might apply. So all of that said, let's look at other options for funding your business. The simplest way to fund your business is to pay for it yourself. Understanding that you have faith in your business, you know you have gone through this analysis, you believe strongly that it's going to be successful. So it only makes sense that since you have the most to lose if it isn't, that your involvement from the funding standpoint is a key. If you are able to fund your business entirely from your cash savings, that's wonderful. If you have investments you might liquidate, again, these are all things you need to consider carefully before you do, but understand that's an option for you. You may have, in some cases, and again, not necessarily recommending this, but if you have a significant enough balance, potential option to fund on your credit card, it's a high interest rate, but it may be funding that you have available based on credit you've built over the years. You may also need to look at equity in your home or other personal property. You would be taking out a personal loan in that case against that equity. But understand that that may be ultimately something you end up doing in some fashion anyway. And many banks will look at that as the option when they look at time to finance a business. They may not look at it as a commercial loan the first time when you're setting up your business. They may look at it as a personal loan, and that personal loan would have the equity that you would expect to need in any kind of personal loan. So your investment is the simplest way. Friends and family is another option. You may have a parent or a sibling who would like to help you make this business possible. The only thing I encourage in that is you might want to look at a formal partnership agreement that divides assets and duties. It's important to understand when you're doing this that it can create difficulties in your relationship if you're borrowing money from a family member or a friend. If the intention is that that person is going to only be a financial partner, then you need to outline that in an agreement. If the understanding is both people are going to have some involvement, then you need to outline those duties ahead of time in a document that you can both refer to later. If your intention is that someone's putting in money and someone's putting in sweat equity that's actually doing the work, the day-to-day work, that can be confusing down the road exactly what that means, and it can create a division between you and family and friends. So just be sure that you're treating those people the same as you would any outside investor. You're sharing your business plan with them. You're going to share your financial statements with them once your business is up and going, and it's important to keep them involved in what's happening. Again, another option, probably the most thought of option, is going to a lending institution. That your first stop should be your personal bank or credit union. Credit unions are not always as interested in commercial loans. That's only recently they've moved into commercial loans at all. So you may want to check with your credit union and see if that's something that they do. Your bank knows you best, so you have a relationship there. So that's another way to get started. If that doesn't seem to be a good choice for you, then you might look at a smaller community bank as opposed to a chain, because sometimes those banks have more interest in investing in the community. So those might be your financial institutions you would turn to. Understand that, especially since the banking crisis in 2009, there are significant requirements for a bank to have when lending money to a business. They have to be able to produce a file when the bank examiner comes that shows they have certain documentation they've required of you. Part of that is they're going to want copies of your last 2 to 3 years tax returns. They're going to want to look at your credit score. Now, a bank will not typically tell you what credit score they are looking for, but realistically, they're asking for credit scores in the 700s ideally, and probably not below 650. So if you can run your credit score, which you can do yourself, and there are a couple of ways to do that, is we're not necessarily asking for your credit report, which is going to talk about how you pay your debt, but your actual credit score. So you're going to want to go to something like Credit Karma or freecredit.score.com. Some of those are free and some of them are not, whether it says free in the title or not. So make sure you're not signing up for something that there's a fee to do, unless you're okay with that. But by participating in one of those, by going through one of those websites, you're going to be able to figure out what a bank is going to see when they run a credit score for you. And you may as well know that before the bank does. So if you run the score and find out your score is in the high 500s, you can know going into it the bank will not look at the loan. So you need to maybe do something to improve that credit score before you go through the financing process. It can take 6 months to a couple of years to make a significant difference in your credit score. So it's a good idea to see where your credit score is today and to monitor it on a regular basis and make improvements by contacting anyone that shows up as a negative to your credit score if there's a misunderstanding or something that needs to be cleared up. Or in some cases, it's a matter of getting credit, getting a credit card, even if it's a low limit credit card initially, charging to that credit card, making regular payments, paying it off, and doing that over a period of time so that you can grow your limit there and you can establish credit. For some people, it's not a matter of not having good credit, it's a matter of not having any credit. So it's important to establish that, and that's what the bank will look for. They also will have you complete a loan application, and part of that will be a personal financial statement. That financial statement is going to talk about what you own and what you owe. So it's going to have your assets and your liabilities. So if you have credit card debt, you'll have that there. If you own a house and you have an outstanding mortgage on the house, what's the balance on that mortgage? If you own vehicles, any car loans that you might have against those. It'll also ask for any kind of savings or 401ks or insurance policies that you're carrying. So it's going to want to look at your total net worth, your total financial picture. One of the things that also will come up there and that will become apparent is whether or not you have collateral available. As you are working on your plans on what you're going to buy for your business, understand the bank will not finance any of that at 100%. A building, they'll probably finance 75 to 80%. Inventory or equipment, well, they'll finance at 50% value. And the balance will be what you'll have to contribute or find other collateral to cover. And again, the logic here is that the bank has to be able to prove that if you default on the loan, you have given them authorization to take assets that what they can sell and replace that money for the people who have put their money in the bank and trusted it to them to invest wisely. And so they are essentially investing their bank customers' money into your business. And they have to be able to prove that they've done everything they can, all the due diligence that they can, to make sure that money will be repaid. So that's the logic behind that. Also understand that this is going to take time. If you've ever purchased a house, gotten a mortgage, you understand the time it takes to do that. This is at least that long and maybe longer. A conventional loan can take weeks or months to go through the process. So keep that in mind in your planning procedures. The other thing to consider is what to do if the bank says no. We've talked a little bit about the SBA guarantee. And again, the logic behind this is the SBA takes on a portion of the debt. So it may be 40% of the debt. So the bank is putting in maybe 40%, you're putting in 20%, and SBA is putting in 40%. So that's a total 100% of the project. What will happen is if you would default on the loan, the bank will then attempt to collect everything that they can from you. They'll go through the whole collection process, take all the collateral needed. And if there's still not enough money to cover what's outstanding in the loan, SBA will guarantee that they will cover that difference. So it makes it a little more secure for the bank, but they still are going through the collection process. And there are some additional fees on your end that's a part of all of that. It also, the other benefit it offers you is the portion that SBA puts into the process is a little bit lower rate than the bank rate. And it is, the SBA's portion is always a fixed rate. So whatever rate is out there and whatever rate they're using is the rate that will be fixed through the life of the loan. And they will amortize it over a longer period of time than the bank may. So there's a couple of different benefits to you there. But just know that that it is going to add a little bit to the upfront cost. Sometimes that gets rolled into the loan, but just know that that's how that process works. But it sometimes can help make a loan go through that otherwise maybe wouldn't have. Let's see, and then another option is microloan programs. Axion for Time Community Action in Danville had a microloan program. Justine Peterson is another not-for-profit organization that covers this area that has a microloan program. And these are all dollar lenders. They're there to help people who maybe don't have established credit or don't fit all the criteria the bank has. And so it's a way to get money if you can't get money through the bank. Probably it's going to be a smaller amount than you would have expected had you borrowed money from the bank. It's also going to be a much higher interest rate. I would equate it in your mind to a credit card interest rate because they're dealing with more volatile loans. So just something to consider. It's an option if that's something you need, but no, it's not a cheap option. Another option to consider is an angel investor. There's an organization out of Champaign, the Urbana-Champaign Angel Network. Angel investors are not all about just giving you money to put into your business. It sounds like they're these wonderful philanthropic people giving you money. They do invest money, but they do also expect to have a return. They expect to get their money back. It's not a grant. They're just helping you up front if they think you have a project that makes sense and that can be successful, and they see it as not something that a bank would typically finance. They'll evaluate projects that are brought to them, and if they decide to invest, a couple things to remember on your end. One is they're going to be involved in the management process. This is not like a bank that's loaning you the money and just expects their payments every month. They're going to want to help you through the process. They can offer a great help to you because they have people who know what they're doing, who are good business people. That's how they accumulated money to be able to do this, but also know there's involvement that's happening in your business that you may or may not be interested in having. Also know they want an exit strategy. They're there understanding they're going to loan money to you or invest money. They're not loaning money, invest money in your business for a period of time. But it's probably a relatively short period. They're going to want to get out in 5 to 7 years and hopefully sell their part of the business either back to you or to someone else at more than they put in. That's their ideal goal. Now, at the same time, they are taking a risk. They're not quite the same situation as the bank. The bank also may be taking a risk, but they understand they have an ownership share of your business. If the business fails, their money is gone. So it's not that they can come to you personally and say, you need to pay me back for this investment, but they do expect to have involvement in your business, and they expect to be able to sell in 5 to 7 years with some sort of a profit from their investment. Something that was big several years ago and is changing and morphing over time is crowdfunding. You may see people put projects out on things like Kickstarter, Indiegogo, Crowdfunder, and you're essentially putting a smaller version of your business plan online and saying, this is what I want to do with this money, this is how much money I need. There are variable ways of approaching this. In some cases, it's out there and it's an all or nothing kind of thing. So I need $20,000 to make my business happen. People are signing up and saying, I'll give you $100, I'll give you $500. And maybe you've created some sort of level of giving rewards. So I'm opening an ice cream parlor, and if you donate $100, you get a free ice cream cone. If you donate $1,000, you get a free ice cream cone once a month for 5 years. So there are different levels of giving. People put their credit card in, say, I commit to give that amount of money. If you actually raise the $20,000, if enough people donate that you're raising that amount of money, then they will go ahead and charge the people's credit cards, and you'll get the amount of money that's donated less a fee that platform will charge you. So you're not going to get quite as much as you put in, and you only get it if you reach the number. So it's an all or nothing kind of thing. Let's say you had enough people donate to raise $18,000. Theoretically, then nobody's credit card is hit. Nobody gets charged anything. You don't get any money. So there's some pluses and minuses. For one thing, an investor or a person, they're not investing, they're actually donating money to you. They might be more willing to do it because they know unless you get the amount of money you need to make your project happen, they won't be putting in anything. And the understanding is if you don't have enough to make your business happen, what's going to happen? They're just donating money to you that you obviously have thought this through and know you need that $20,000. So that's the logic, and they might be more comfortable giving for that reason. If there are some sites that do another option, which is that you get the money no matter what. People may be less interested in donating in that environment. On the other side, you do pay a higher fee to the platform that's processing that. So you have to weigh all of those things. Another thing to remember about crowdfunding is, well, it was really fun, and people funded movies and different unique startups and electronic gadgets and all kinds of things several years ago. Right now, people have kind of cooled off a little bit on it, and it's not quite as successful as it was. Even at its height, the most of the money that was generated came from people that knew the people starting the business. So in order to generate money on one of these platforms, you're going to need to work this. You're going to need to send emails out, social media messages out to friends and family, encourage them to share them, try to get as many people as possible to donate and to sign up to be a part of this with you. And what'll end up happening is they will, if 75% is the rule of thumb. 75% of the money comes from friends and family or people you know. So it's not necessarily that this is going to be somebody on the other side of the country that's going to invest in your business, but someone that you know, and it's just maybe easier than going up and asking your friends for money. So it's just another option. In your packet, you'll also have a checklist for starting your business. In this particular case, it's set up for Vermilion County. So when you go through that checklist, that document, you're going to see a lot of the same kinds of things we've talked about in these sessions. You'll also see a detailed list with links to the various places that you need to go to do some of the basic startup pieces, the nuts and bolts of business startup. And our next section is going to just touch on those nuts and bolts that we haven't covered already. So we'll talk about that shortly.